So are we ready to, then should we just dive in?
So, Chair Kauka, could I call roll call and establish quorum before we start? Okay. Chair Kauka,
Present.
Vice Chair McClatchy,
Here.
Commissioner Clares,
Present.
Commissioner Fry, absent, Commissioner Callback,
Here.
Commissioner Richmond.
Here.
We have quorum.
Yay, great. Okay, so all right, so time for a pledge. Is that optional or we do it? All right, let's do a pledge.
Do we have a flag?
I don't know.
Oh, there we go. Nice job, Martha.
All right. I pledge allegiance to
Allegiance
Dude,
to the flag,
the United States of America,
States of America,
to the republic,
republic for which it stands,
one
one
nation,
nation,
under God,
under God,
indivisible,
indivisible,
With
with liberty and justice for all.
Oh, great job. Okay, super. All right. I think Helen, since I wasn't here last meeting, do you want to open up with the minutes from the last one, and people who were here can vote on it?
Chair Colcott, before we do that, we should see if there is anybody wishing to speak
yes.
on items not on the agenda.
Sure. And if there's anybody who's any visitors who'd anyone have a
So, Chair, if no one else is, I wanted to give the public a chance to comment first. If no one else is, I would like to address the board.
Yes, please go ahead, Gabe.
All right. Thank you for having me here tonight. I'm trying to stop by and meet all the boards and commissions and put faces to some of the names and the emails that I've seen, with the exception of Gary. Gary and I are good friends. We've been working together already. And I just talked with the chair for about 20 minutes. But I look forward to working with this commission quite a bit. We appreciate all the work and dedication and the volunteerism and all the hours that you put in. John Maginot and I, with Helen and the finance team, are getting ready to bring a lot of items forward to this commission. And we're excited to talk through how we budget, what we look for, and we really look for feedback and consideration and guidance from this board. But mostly tonight, I just wanted to come and say hello, introduce myself so anyone who hasn't met me yet knows what I look like, and just answer any questions you have, or we can do it offline too, whatever is the preference of the board.
Great. I think we have some time for staff announcements, etc. So maybe we'll call on you. I think the most pertinent thing for us is sort of for this commission is, of course, the hiring for the finance director. So maybe you can help us with an update on the process, etc. at that time, and we may have other questions at that time. Thanks, Gabe. We're really happy you're here. Welcome, and excited to get started with you. And hopefully, we're all retired, and you're still our city manager.
Thank you. Happy to be here.
We're looking for longevity, and whatever we can do to help you succeed in your role, that'd be great. Yeah, we're all here for you. Okay, John, public comment this time, or do we just dive in? We asked, but did we specifically ask if somebody wanted to speak to this?
I'm public, but I have no comments. I'm just observing tonight.
Okay, and I see Monique, and SV is the other person.
I'm not seeing any hands raised for individuals wanting to speak.
Okay. All right, then I think we can dive in. The minutes are up.
Move approval of the minutes.
Second.
Okay, I'm going to call roll.
Yes, please.
Chair Colcat,
I abstain. I wasn't here.
Vice Chair McClatchy. Vice Chair McClatchy. Oh, you're on mute, but it's move. Okay. Commissioner Claras,
Approve.
Commissioner Fry, absent. Commissioner Callback,
Aye.
Commissioner Richmond.
Approve.
Minutes have been approved.
Okay, great, fantastic. Okay, so we have mostly just one item this time. So a presentation from PFM.
Yep. Yeah, if I could just jump in really quick, I will just have the pleasure of introducing Monique from PFM, who is the city's primary investment advisor. And she's gonna has a quick presentation for you, and then we'll have a chance to answer some questions and from the commission. So Monique, take it away.
Thank you. Good evening, everyone. Thank you so much. I appreciate your time this evening. Helen, would you like me to share the presentation materials?
Yes, sure.
Happy to do so. I'm going to get them open on my screen. And
Actually, if it's easier, I can share as well. I didn't know your preference.
yeah, that'd be great, Helen.
Okay,
It'll
sure.
take me a while to get it up. All right, well, good evening. It is a pleasure to meet with you today. We have prepared a presentation just to give you a summary of where the investment portfolio sits currently, and also some thoughts on the investment policy for the city's portfolio. So with that, I'll just jump right in and talk briefly about PFM. I have spoken in front of the commission before, but for those of you who may not know, PFM is a leading investment advisor in the area of public sector finance. We've been managing assets for public agencies like the city for the past 41 years. We have about 237 investment professionals, 29 of which are CFA charter holders, and we have a very long tenured team. On average, our team experience has been about 23 years, and I myself have been working in this business for the past 18 years. We manage or advise on 170 billion in total assets. A great deal of our practice is for California public agencies like yourself. We are a fiduciary. We do not take custody of any assets in the portfolio. Rather, we manage the city's portfolio against the investment policy that I know the Financial Commission offers its opinions on. And our goal is to protect the safety of the city's assets, to ensure that you have adequate liquidity to meet your needs, and then finally to offer you a competitive rate of return versus what's available in the market. With that brief introduction, I'll move right into the main topic of tonight's discussion, which is the portfolio itself. Now, we manage the city's portfolio to a 1 to 3 year strategy, meaning that on average, we're investing the city's portfolio in securities that will mature over the next 3 years. With that strategy, I thought it would be appropriate just to lay the landscape of where the interest rate environment has been over the last 3 fiscal years, fiscal year ending 2021, fiscal year ending 2020, and fiscal year ending 2019. Now, I think the biggest story over the last few years, of course, has been the drastic drop in interest rates as a result of the coronavirus pandemic. If you looked at where interest rates were a couple years ago, June 30th, 2019, you could see the vast drop over the last 2 years to where we sit today. In 2020, the Federal Reserve essentially lowered the federal funds target rate by 150 basis points, which caused rates to drop dramatically. Since 2020, rates have slightly elevated on the longer end of the yield curve. If you look at this blue line, that's where the yield curve ended the fiscal year, with the 5-year Treasury at 89 basis points and the 3-month Treasury bill at 4 basis points. Now, what does this mean? That means essentially we've been investing in a decreasing or declining interest rate environment. And just recently, at the tail end of the fiscal year, have we started to see interest rates climb back up. Moving forward in the presentation, what impact has that had on the city's investment portfolio? Well, we're investing a securities portfolio of about $55 million on average for the city. We have been investing in a declining interest rate environment over the past few years. The average duration or average maturity of the portfolio is about 1 year, 1.86 years. And the yield on the portfolio is about 94 basis points. Now, when you consider that the portfolio has a relatively short duration and a relatively short average life, that 94 basis points is a very attractive yield. We're very happy with that yield for the 1 to 3 year strategy. And the 2-year Treasury, just for some context, sits at about 20 basis points today. Now, our primary drivers for strategy for the city's portfolio has been to diversify the portfolio. If you look at the chart on the top right, the sector allocation, one of the things you will note is that it's a very colorful pie chart. We have opted to essentially try to leverage your investment policy to the extent we can, investing in security classes outside of U.S. Treasuries, which offered some additional income or yield above Treasuries. And that dynamic has led to our ability to deliver returns in the portfolio and to have some income over and above where the Treasury curve has been. While we've done that diversification, we've also managed to keep the credit quality of the portfolio very high. If you look at the chart in the bottom right corner, you can see that on average, the portfolio is rated in the AA category. Now, these are S&P ratings, and I note that S&P does rate U.S. Treasury obligations at AA+. So that AA category does include all your U.S. Treasury obligations and all your federal agency obligations. We have a very highly rated credit portfolio. And for the credits in the portfolio that you may note on this pie chart is rated BBB or non-rated, we added a footnote just to confirm that those securities are rated in the single A category by Moody's and or are rated or not rated by S&P, but are rated by another rating agency. Moving forward in the presentation, because of the diversification strategy, we've been able to deliver tremendous performance to the city's portfolio. Now, I said a few times that we are managing the city's portfolio against a 1 to 3 year U.S. Treasury index. And that index is fairly short, again, invest securities across 1 to 3 years. But we use the 1 to 3 year U.S. Treasury index as a benchmark for the portfolio because it provides a baseline, a risk-free baseline benchmark for the portfolio. And it allows you to more clearly see what that diversification is adding to the portfolio. As you can see, for the past fiscal year, we've been able to outperform by 37 basis points in the portfolio. For the past 3 and 5 years, those historical trailing returns, we've been able to keep that performance. So we're really happy with that performance. And a lot of that has to do with our diversification of the portfolio while really focusing on the liquidity characteristics of the portfolio. Now let's talk a little bit about the future. One of the very unique things about this current interest rate environment is that things have been fluctuating a fair bit and things have risen and fallen to some extent on news of the coronavirus pandemic. I included this graphic here to give you just a really quick visual of where we see the fixed income sector today. And one of the things I want to point out is that the sort of green colors are our favorite things, the things that we're really excited about and where there's a lot of value in the market. And the orange and yellow colors are, you know, just not too excited, not a lot of value, really challenging. Not to say they're negative or they're bad, but just really expensive, I think is the best frame for those investments. So you'll note right off the top that there's nothing in the green. There's nothing we're excited about in this current market, but there's a lot of things that are in the yellow and orange. So really, what are we looking at? One, things have gotten very, very expensive in the market. Federal agency securities, I'll speak about those first because they're solidly in the orange, have just gotten extremely expensive. In some cases, Treasury securities are out yielding federal agency securities, meaning that in some areas of the yield curve, you could receive a higher yield on a Treasury security than you would on a federal agency security. We noted there was a commission question about the federal agency allocation in the portfolio. And, you know, I would say that we have not purchased a federal agency for the city's portfolio since December of last year because of how expensive they've gotten in the marketplace. Corporate notes are another sector that have experienced really tight spreads, meaning that the amount of additional income you received on corporate bonds has come in significantly. Part of that has to do with the demand for corporate bonds. There's essentially a lot of cash in the short duration fixed income markets, and that cash is seeking a home. And there are a lot of buyers for corporate debts, and that's really putting a lot of pressure on those prices. So we continue to evaluate what the opportunities are in the corporate market. We're believers in diversification, so we're trying to find value where we can. But as a whole, that sector has just been very expensive along with federal agencies. Other spaces where we hope to be able to find some value include the super space, supranational bonds. Those are your rolled bank bonds. Those bonds have seen some spread tightening and some slowdown in issuance, but when we do find those bonds, we're trying to take advantage and really use your investment policy to the extent we can. We think it's going to be very important on a going forward basis to try to keep that diversification strong in the portfolio. There has been some talk about the Fed perhaps changing their interest rate policy sooner than anticipated. That means perhaps a rate increase in 2023, not this year, not next year, but perhaps in 2023. So we have some time before rates are rising. And until then, we want to really keep up finding diversification. Shifting gears a little bit, I want to talk about the city's investment policy. We included another graphic here to give you a visual of what your investment policy currently allows, what the California government code limits are, and where we currently have allocation in the portfolio. So the blue columns are your investment policy limits. Where you see that shaded granulated blue, that's where there's some additional capacity in the California government code, and the yellow diamonds are your allocation. So when we were considering investment policy recommendations this year, we thought about a lot of things. We thought about best practices in the market. We thought about where you're currently positioned in your policy versus what the government code allows. And we also thought about where we believe we need more opportunity. We need larger opportunity sets. And as you can see here, there's no diamond, yellow diamond that's currently pushing against your blue policy limits. Therefore, there's nothing in our current strategy that would cause us to sort of go to city staff, come and discuss with you some changes to the investment policy statement. There have been no best practice recommendations that would impact your policy. We've been reviewing your policy for a number of years and believe it is consistent with current best practices and changes. Now, there has been some changes to the California government code that we wanted to put in front of you and inform you of, which we, I believe, have outlined on the next slide. There's a lot of text on this page, so I will just summarize it for you here. Last year, last year, there was a bill put in place that took effect at the beginning of this year, Senate Bill 998. And what that bill was meant to do was to provide local agencies, public agencies like the city in California with some additional investment options to specifically weather the low interest rate environment that has been caused by the coronavirus pandemic. So because, again, the Fed lowered interest rates by 150 basis points and this low interest rate environment was expected to persist, there was a bill introduced that would allow some more flexibility for local agencies. And some of the changes included the first bulleted or sub-bullet point on here would allow local agencies like the city to purchase securities backed by the US government, so essentially treasury level obligations that could result in zero or negative interest accrual if held to maturity. So essentially purchasing a treasury bill or bond that could have a negative interest rate. That was the first change to the code. Now, when I talk about this change, often the question I receive is, why would we ever buy a negative interest rate security? Why would I ever purchase a negative interest rate treasury bill? Well, because of the low interest rate environment, what you may see is local agencies start to be charged by their deposit institutions for holding cash balances. So you may see higher fees at your banks, fees for money market fund investments, etc. So by allowing you to purchase negative treasury bills, it allows you to deposit your funds in a treasury bill and pay a fee via negative interest rate rather than paying a fee to your bank. So essentially it gives you some flexibility, and that's what that change is essentially meant to accomplish. The second change allowed local agencies that have more than $100 million for investment to invest up to 40% of their portfolios in commercial paper. The current limit is 25%. Now the city does not have $100 million in assets currently, so this change does not apply to the city's portfolio. Therefore, we did not make any recommendation that you consider this. The third change was deleting language in the government code that spoke to the applicability of commercial paper, essentially saying that the current limit or the previous limit in the code that required you not to buy more than 10% of an issuer's outstanding commercial paper was deleted. The next change was establishing a 10% per issuer limit on commercial paper and corporate notes for all local agencies. Previously, the California Government Code did not have any per issuer limits. We did not recommend that the city adopt that change because the city's investment policy already has a very stringent per issuer limit of 3 to 5% per issuer. So your current policy already had issuer limits and is now more restrictive than the code. And then the last change was allowing federally recognized Indian tribes to invest and participate in local government investment pools or joint powers authorities like the CAMP program. So on the next page, we summarize more specifically what recommendations we're making to the city. We do recommend that the city consider adopting that change regarding the negative interest accrual. For being able to purchase treasury bonds, bills with negative interest rates. Again, this is just something that will give you an option in the event that you have bank deposits, you're paying a fees, and you want some other opportunity. The other changes, as we note, we did not recommend you implement. Either they were not applicable to the city or not appropriate given where your policy currently stands. And I believe that is my last formal slide.
So Monique, just on the last, then the recommendation you're saying, I mean, most of the money that you're not managing is held in LAIF, you know, so I don't know if, do you know if LAIF actually has, I mean, that's a stake, right? So that, do they actually charge us for holding that money? I mean, could that impact us? So that
No, I don't believe the state. The state has from what I understand, and Helen and John, please correct me if I'm wrong, but the state provides an interest rate that's already net of any applicable expenses of the pooled funds. Okay, so the negative interest accrual securities would be an option if the city had cash elsewhere, if the city has a banking relationship. It's essentially an option in the code.
Yeah, I mean, we do, but we don't have a lot of money in our bank account. I think we do generally, but I'm open to doing this, but I don't think we have an emergency need for doing this right now. But if we want to change the policy, I'm up for a discussion on it. So I'll just open it up to the rest of the council commissioners if we think it's worthwhile to think about this and put it on the agenda next time.
This is Gary. I think we should put it on the agenda next time. It's probably a moot point to some extent, but you'd hate to get caught having to pay to have somebody keep our money if we had options. So I would like to consider it an agenda item for next time.
Okay. The point of putting it on the agenda is to be able to carefully structure some language
Right.
that we can suggest to PFM in terms of guidelines under which environment or conditions they should go ahead and proceed with a negative interest rate investment and where to leave it alone.
Can you hear me, or am I still on mute?
No, you can hear you.
Okay. In addition to what Gary has just said and Kaljit has suggested, can we have an example, or can somebody provide an example of what it is that we would be paying using the negative interest rate accrual versus negative interest rate investment versus what we currently are doing, so that we can see that there is a benefit to doing it?
And make Monique's point for she ought to speak for herself, but I think what we're talking about is this negative interest predicament exists fairly widely in highly solvent European sovereigns, for example, in Germany, Switzerland, et cetera. It's been pretty common. I knew the number at one point, but a multiple $1 trillion of sovereign debt now trades negative.
Mm-hmm.
So I think the sole suggestion is to create that as a red phone you could pick up without having to run to the city council to amend if you have some rollover and you need to park it someplace, because the advisor, I think, would feel constrained that they couldn't buy a negative piece of paper. So it's happened. I don't have any problem with it. My only overlay on it, you ought to put on the agenda. And if I was writing it, I'd indicate to the advisor that they ought to get a sign off from, whether it's the city manager, somebody ought to sign off on making that decision, because this is really an escape valve. If US looks like, Germany, I think is the best example. Other than that, I don't have any objection to it.
And it would only apply to us if we had a lot of cash parked at our bank, and we were paying some management charge fees for.
Yeah, I don't think she's really talking about bank charges. We're just talking about what happens if the short-term treasury curve goes negative, which I don't think has happened. Maybe there's been a couple of days, and we have money rolling over, and she has to put it somewhere.
Yeah.
And then she's got a hard decision to make of whether she takes negative for the volatility to sort out, or she goes out the risk curve.
Right.
And I think that's the predicament we're dealing with.
Yeah, I think that's right, Tony. And I like I'm going to take your red phone and use that in other presentations. So thank you for that example. But I think you're right. It's a matter of where do you park the funds, and having some options on parking it. Throw it to the bank, pay a fee there, put it in the treasury, pay a fee there for a couple days.
If the bank charges us nothing, we could move the money to the bank and leave it there and start buying negative. But if the banks charge us, then this is an option for us to consider. So I think we should just get the language sorted out and then the next agenda item. So now this is the dilemma.
Kaljit, you went on mute.
I'll work with John and we'll figure that out and create the agenda next time.
Good.
Okay, thank you. Thank you very much for the presentation. Very clear. I think this was one of the better presentations we've seen from PFM. So thank you, Monique.
Thank you, Monique, so much.
Monique, before you go, could you
Yes.
answer a question I have?
Yes.
Are Supernationals guaranteed by any government?
They are not. You should consider supranational securities essentially very similar to a government-sponsored corporate enterprise. So we would consider Supras, and we wrote, I believe there was a question about Supras from the last commission meeting, and we wrote an agenda detailing them, but they're essentially corporations of which the shareholders of which are countries, essentially, and the supranationals who are allowed or permitted by the California Government Code. The United States is some of the largest shareholders in that corporation.
If the supranational isn't guaranteed, what is the advantage of owning that versus, say, treasuries or agency bonds or something like that?
So Supras are highly rated. They're considered quasi-government institutions just because of how they're structured. Again, getting the support and the investment from the countries who serve as the shareholders of the corporations. They are higher credit quality in some cases than U.S. Treasury, certainly by S&P and other rating agencies, just the way they hold their funds. They provide a better spread to U.S. Treasuries than federal agencies do, and they're a great substitution for federal agencies. One of the reasons we started recommending Supras for investment policies a couple years ago when they became allowable for California Government Code was the idea that they would be a great stand-in for federal agencies when the federal agency market became constrained through supply and or lower yields, and that has proven to be the case.
So the last time, John, we discussed this, I think the one subtlety of the Supras which kind of cautioned us a little bit is that most of the Supras that are in the example in the memo, World Bank, my father spent half his career there, etc. The corporate and the board is United States. Most of the time, the head of the World Bank is a U.S. banker. But there are Supras in the world that are run by the Sultan of Brunei. They're run by the Sovereign Fund of Singapore. And the question is that, should we be investing as a city, and how much do we know, or how much visibility or clarity or transparency those Supras have for us to be able to feel safe about them? So that's why we've always been a little hesitant to go in the Supra direction. But I think we did feel that I think the PFM is probably doing a fairly good job in managing that risk.
Yeah, and keep in mind too that the California Government Code only allows for 3 Supras for California local agencies to be invested in.
I see.
And those are the ones that are domiciled in the United States, the ones where the U.S. is the shareholder. And I'm pulling up the list of what 3 those are. But it's a very specific list. To your point, it thought about those considerations, like who's managing the Supra, who's on the board, etc.
Who's sort of the chairman, like if some country decides that it's okay to default on a loan because of political reasons, then our investment's kind of in the tank, but it has political value to somebody else, and that's a risk for us.
But I think these are highly diversified pools.
Yeah.
With a lot of paper that rolls over, and we already capped them below the limit we could cap them. And I think what we're telling PFM is constructively chase yield, and if there's no yield, don't chase it.
Right. Yeah. No, I was just telling John about the history, the conversations we've had on this thing in the past.
I guess the question I have is with regard to the Supras, if they aren't guaranteed and we only get a marginal increase in yield, are we not assuming more risk for not that much additional yield?
Right, but John, with all due respect, if you look at this curve, whatever yield you get, you're taking some risk and not getting much for it. So you have a decision: you either sit at 7 basis points, or with some real guardrails, you have an advisor go out and look for a little bit of yield on a diversified basis and judge what they're getting for you. I just think it's hard on a rifle shot basis on a particular day in August to say we really should move anywhere, because this thing keeps moving on us. And Monique helped me, but I think these are highly rated institutions that you have, and whether they're probably not triple, but they're probably double, but you tell me.
They are AAA rated. They're some of the highest rated securities in your portfolio. They are considered quasi-government investments. High quality, we have no issues with them. We do consider them sort of as part of a government portion of the portfolio. And we have no qualms about them from a credit perspective. And I would set them apart, although they're structured like a corporation, I would set them apart from regular corporate debt. And we do believe we're getting a good value for the investment.
Okay.
Thank you for the explanation.
Yeah. Okay, thank you very much. Anybody else have any comments on this topic or?
No, I think you guys are doing great. You went out on term, you benefited from it. You know, I never thought I'd say congratulations for doing 94 basis points on cost, but you know, terrific so far. What are you going to do next year?
Compared to what?
I mean, your refinancing risk is huge, so it's, you know, it's a hard market.
Yeah. Keep it up.
We thought we got a great deal on a 2% loan, but now I see why we got a 2% loan.
Well, we got a 2% loan because we got in front of 6%, you know, construction inflation.
Yeah.
That's a different discussion.
Right. Yeah. Okay. Thank you. Thank you, Mike. All right. Should we move on to the next topic then? Do we want to do a staff report?
Sure. Or I'm assuming you all asked your questions about the quarterly investment report to Monique. If you haven't, I think now is the opportunity to. Otherwise, we can move on.
Okay. It's like
not here. Yeah.
Go ahead.
Okay. So brief staff report. The item listed there, I wanted to give an update. We are bringing at the next meeting a discussion of that $5 million reserve. So hopefully the commission can make a recommendation on what to do with that $5 million. We'll have some options and some recommendations from staff for your consideration, and then we can get that to the council and do something with that. So I just wanted to let you know that that will be coming at your next meeting. Earlier there was a question, and Gabe apologizes, he had a meeting at 6:30 that he had to jump off at for. There's a question or request for some updating on staffing. Very briefly, I'll just let you know we've made an offer to an individual to be the finance director. They're still in backgrounds and the whole process of that, so I can't provide any more information or details on that, but hopefully at your next meeting I'll have somebody here with me. Since Helen's leaving us and I'll be all by myself, then hopefully we'll have somebody else with me next meeting, and you can get to know that individual and they can start running.
And if it's any of the last three people I met, I think we'll be very happy. We'll be quite pleased. I'm really pleased that John and the team did a great job in selecting candidates and getting them through the funnel quickly. Great. Thanks, John.
And other than that, I think you probably all saw Helen's email to you. We are very sad to see her go, but very excited for her future and her opportunities that are coming her way. So we will miss her, but thank you very much, Helen.
Good luck,
for everything
Helen.
you've done.
Yeah.
Thank you, everyone.
Good luck.
Yeah, we will miss you, Helen.
Good luck, Helen.
Thanks so much. It's been a blast just serving alongside everyone and listening to all the financial knowledge everyone brings. I really have been very lucky to be a part of this group and to learn from all of you. So thank you so much.
Not at all. You kept us straight. That's good. Thank you. Okay. Yeah. This is it's an odd way to sort of say bye in virtual world, but at least we've met in person once a few times, so that's good. Okay, thanks. Anything else, John?
Nope, that's all I have for you.
Okay, and then topics for next month's meeting.
Mm-hmm.
Besides what you're bringing, I think you had some recommendations.
Yeah, so we have listed the 5-year projection and analysis. We'll see if that is ready to go by then, but certainly the big discussion will be on the $5 million for the CalPERS reserve.
Okay.
And then a specific recommendation on the prohibition on investment.
Yes, we'll bring that back as well. Thank you, Gary.
Yeah, good, thanks.
I did write that down in my notes, so we will.
I'm sure you did.
Make sure
I'm
we
sure you
bring
did.
that back.
Yeah, good.
And do you know we have a vacancy on our commission? So do you?
Yes, the thing. Oh, thank you. That was the. Thank you for asking. That was the other thing I was going to bring up. The recruitment is currently underway, including one position in the Financial Commission. I believe interviews are the end of this month or beginning of September, with the hope that appointments will be made in September. I don't know if new commissioner will be seated in time for our September meeting, but certainly by October, I would anticipate we'll be back up to full strength.
Yeah, our Vice Mayor Andrew here, the commissioner interviews are scheduled for August 31st. And if that all works out, then we should be able to appoint by the September 14th meeting and get people sworn in time for the meeting on the 20th.
Good.
And we have enough interest. I mean, I've had 3 phone calls, but that doesn't sound like a lot of interest. You know, we are kind of an odd commission. I mean, you know, you have to be kind of a little bit of a numbers nerd to want to be on this commission. So I hope we get we have enough.
Well, and not knowing how many applicants we may have received so far, and the application deadline is still has yet to come.
It's Friday. This Friday.
This coming Friday, yeah. As you all know, it only takes one really good one.
Yeah. Okay. Okay. Excellent. All right. So good things happening. And we're excited about a finance director. And are you going to just leave filling all the other positions in the finance department? And we have quite a few to the new person coming in, or are you actually starting to look for a finance manager and all that already?
We are starting to look. Yes.
Okay.
Hopefully we can get the finance department up to full strength as well very quickly, because there's a lot of work to be done, as you all know.
Yeah.
And so hopefully we'll be able to get folks in and up to speed quickly.
Great. Okay. Okay. Anybody else have anything else to share?
Nope.
Nope. I'd like to thank John.
Okay. Meeting adjourned. Thank you, everybody. See you in a month.
Thank you.
See ya.
Thank you.
Thank you. Bye.
Bye.